Hello everybody, welcome to this second video of me learning how to trade with Forex. So just as a recap from the last episode, I guess, in the first episode which was the last episode, I did a brief introduction of myself and the channel and what it's about, and from that we basically got to the point that I have no idea what to do with Forex, and your boy just basically knows nothing about Forex. So we made a plan about how to start learning Forex. So for example, I treated this as a project. So we start off, I think I did a was it like a literature review or whatever it's called. So I treated this information review as like literature review. So basically just trying to find out what the current information available online or anywhere regarding Forex is. So we came up with a research question, some objectives, and then some sort of information sources that we can get these information from to answer the research question. And from the quick search of using like the keyword Forex, I think we found a few websites at the top you can see. And in the last episode we just read through, I think, the beginning bit of this web page, which is called from Investopedia, and I should probably now look at this insert layout to the left, page name, there we go. So Forex forward transactions, well, this is called Forex FX definition, how to trade currencies and examples. Cool, so let me just center that. Okay, so you know what, let's just do this as well. Right, okay, so this is the sort of notes I've made in the first part, basically just detailing what's through here, so up to until triple the usual amount up to here. Yeah, so in this video we're just gonna carry on from where we left off from last time. So yeah, Forex full transactions, any Forex transaction settles for a date later than spot is considered forward. Any foreign that settles for a date later than spot is considered forward. Any Forex transaction that settles for a date later than spot. I'm guessing the spot is when is our spot actually? That is that the rollover date maybe? So I'll just write that down anyway. We can come back to this later. So Forex transactions that settles for a date later than spot is considered a forward. The price is calculated by adjusting the spot rate to account for the difference in interest rates in the currencies. The amount of adjustment is called forward points. Right, okay, so the price is calculated by spot rate, not interest rate, the spot rate to account for the difference in interest rates. to account for the difference in between the interest rates between the two. Account for the difference in interest rates. Account for the difference in interest rates between the two currencies. This amount of adjustment is called spot rate, isn't it? No, forward points. It's called forward points. The forward points reflect only the interest rate between the two markets. The forward points are only differential between two markets. They're not a forecast of how the spot market will trade at a date in the future. As forward is a tailor-made contract. It can be a minute considered a day. That's not weak enough. Funds are exchanged. So the forward points reflect only the interest between the two. They are, so they don't actually predict. They aren't a forecast of. They aren't a forecast of how the spot market will trade at a date in the future. A forward is a tailor-made contract. It can be for any amount of money, can set on a date. That's not a weekend. As in, the funds are exchanged as in a spot transaction, funds are exchanged on the settlement date. Forex futures. A forex or currency future contract is an agreement to deliver a set amount of currency at a set date, called the expiry in the future. So transact later than spot. Forex or currency future contract is agreed to deliver some amount at set date, called the expiry. A future contract is an agreement between two parties. To deliver a set amount of currency, isn't it? A set amount of currency at a set date, called the expiry in the future. Future contracts are traded on an exchange for set values of currency and with set future contract traded on an exchange with set expiry dates. Unlike a forward, the terms of a future are non-negotiable. So this, it can be for any amount of money. I should probably add that in then. A forward can be for any amount of money and can settle on any date. That's not a weekend or holiday. But this one, however, a future, a future is non-negotiable. A profit is made on the difference between the price the contract was bought and sold at the profit is made, a profit is made on the differences between when the contract was bought and when it was sold. Most speculators can't hold future contracts until expiration, as that would require the delivery cycle. Instead of buy and sell price, realizing losses on it. Don't really know what that means, to be honest, but we'll probably find out more about this later on. How Forex differs from market. There are some major such as the US stock market. There's fewer rules. This means investors are held as regulars. There are no clearing houses and no central bodies oversee. You can short sell at any time because you're not actually shorting. If you sell one currency, you buy another. Fees and commissions. Most brokers make money by marking up the spread on currency pairs. Others make money by charging it well, which fluctuates based on the amount of currency traded. Some brokers use both. There is no cutoff as when you cannot trade because the market is open. You can trade any time of day. The exception is on weekends or when no global finance is open due to a holiday. Leverage. The Forex allows leverage up to 1 to 50 in the US, even higher in some parts of the world. That means a trader can open an account for 51 and buy or sell as much as 50,000 in currency. Leverage is a double-edged sword. It magnifies both profits and losses. Oof. A leverage. Is a ratio between I guess your actual money against what you can trade with. A ratio, a leverage of 1 to 50 could mean you start with £1,000 and can buy and sell as much as £50,000. However, leverage is a double-edged sword as it both magnifies profits and losses. Examples of Forex transactions. Assume a trader believes that the EUR will appreciate against the USD. Another way of thinking is that USD will fall relative to EUR. Assume a trader believes that EUR will appreciate. Another way of thinking is that USD will fall relative to the EUR. So that means each USD is going to be worth, is going to take less EUR to buy. Right, I think the trader buys EUR 1 point and purchases 5,000 worth of currency. Later their price has gone to 1.5. Later the trader is up $25 50 times. If the price drops to the trader will be losing $35. Right, okay. So you would ideally, right, okay, so 1.25. Right, okay. So if you bought something, basically, you'd want this number to go up, and if you're trying to sell it, you would want this to go down. I think. Maybe. About the rollover. Currency prices move constantly, so the trader may decide to hold a position overnight. The broker rate resulting in credit or debit based on interest rate differential with the US. The Eurozone has interest at 4%, and interest the trader owns the higher. The Eurozone has interest at in example, the trader owns a high interest rate currency in this example. The trader should receive a small credit if the UR interest rate was lower than the USD rate debited to the rollover. Can affect trading session, especially if trade can be held for long term. Harder can result in significant credits or debts, which can greatly enhance the road profits or of the trade. Most brokers provide leverage. Many US brokers provide. Let's assume our trader uses. If using 10-to-1 leverage, the trader is not required to have a £5 account, even whilst trading £5 worth, only 550 instead. Because if using 10-to-1 leverage, uses 1 to 10. If using 10-to-1 leverage, the trader is not required to only 500, because 500 times 10 is 5,000. In this example, a profit of 25 can be made quickly, so the trader only needs, or even less, if using more leverage. That shows the power of leverage. The flip side is that the trader could lose capitals. In this example, a profit of $25 can be made considering the trader only needs £500 or $250 of trading capital. Forex can be risky and wrong credit to that. It's like how the traders will high lows of capital. How much do you need to start trade? You can start trade around, that'll be enough to start, but this is all, this is lose. There are many risks. The exchange rates are very changing often, meaning also in addition there is a trend currency Forex in right, okay. Part of day trade introduction. This is probably what I should have gone through actually. So I guess this is the notes we've made on that Investopedia page. To be honest, I kind of understand the general bits, just explaining what Forex and stuff is, but at the end bit, I just got lost, so I think more reading is required. What is a good next website? I kind of do want to start going through like part of day trading introduction, this bit here. But which number is this? This is number 3. No, this is number 2. Forex trading strategy and education. Right, it seems like there's loads of guide to Forex trading, Forex stuff on this Investopedia. IG.com. Oh, this is a bit of infographics. I like this one. Let's go with this one. So, let's look at a new one. What is this called? This is on IG. What is Forex? And how does it work? Date accessed 02/01 2020, 2024. 0201 2024. So, what is Forex and how does it work? Take a closer look at everything you know about Forex, including what it is, how to trade it, how to leverage interest in Forex, for example, practicing on demo. Right, okay. IG, isn't this a gaming thing? No, I'm tripping. Ignore that. Written by, what is Forex trading? Forex trading, also known as FX, is conversion of one currency to another. A conversion of one currency to another. Carry around transaction every day. Net worth. Damn. While lots of foreign exchange is done for practical purposes, I'm going to take my forex to earn a product amount of currency can make it.
Forex trading is how individuals, banks and businesses convert one currency into another. Trillions of dollars worth of Forex transactions take place every day, making it the largest financial market in the world. Unlike stocks or commodities, there's no central exchange for trading Forex. Instead, currencies are traded via a global network of banks, dealers and brokers, means that retail traders can trade Forex day or night, Monday to Friday. So how does it work? Well, Forex prices are quoted in pairs, because in effect you are simultaneously selling one currency while buying another. Let's take euro-dollar as an example. On the left is the euro, known as the base currency, on the right the dollar, or the quote. If the price of euro-dollar is 1.38, that means 1 euro is worth $1.38. When trading Forex, you're always quoted two prices, the buy and the sell. The difference between the two is called the spread. You'd buy this pair if you thought that the base currency will strengthen against the quote currency, known as going long. Alternatively, you'd sell if you thought that the base currency will weaken against the quote, known as going short. Forex prices are influenced by a range of different factors. These include interest rates, inflation, government policy, employment figures, and demand for imports and exports. And because of the sheer volume of traders and the amount of money exchanged, price movements can happen very quickly, which makes Forex not just the largest market in the world, but also one of the most volatile. To start trading, open an IG account today.
Okay. Learn currency trading 6 steps. A forex pair, right? This is the some juicy stuff. This is what is a forex pair? A forex pair is a combination of two currencies that are you know what, I'm just gonna yoink. Oh, and paste in. Just paste that in. That's a very nice image. I like my images, they look nice. So, very cool, very cool. What are the base and quote currencies? The base currency is on the left. Alright, so base currency on the left, quote currency on the right. The base currency is always equal to 1, right? Base currency always is 1. Quote currency, what was this? Is equal to the current quote price of the pair. Is equal to the current quote price of the pair is equal to the current quote price of the pair, which shows how many of the quote currency shows how many of the quote currency is needed to buy one base currency, right? One of the base, yeah, boy. So we are trading currency, always selling one to buy another, selling one to buy another, selling one to buy another. It's another very nice image which I am going to put in here. Oh. Oh, why has it done that? What the hell? What is a pip in Forex? Wait, so just regarding this image, you're selling one to buy another, you're always selling one. So you're either selling €1 for 1.3 USD, or you're selling 1.3 USD for €1. Right, okay, okay. What is a pip in Forex? Pip is a one-digit movement in the fourth place, that's very specific, in the fourth place, in the fourth decimal place, in the fourth decimal place, one-digit movement in the fourth decimal place of a currency pair. So if it moves from 1.35361 to 1.356, then it has to move a single pip. But if you're trading JPY crosses, a pip. But if you're trading so if GBP/USD moves from 1.35 to 1, then it has moved a single pip. But if you're trading JPY crosses, a pip is a change in second place. Right, okay, so what is it? But if trading JPY crosses, I'm assuming crosses means the pair, right, the currency pair, a pip is a change at the second decimal place, so it'd be 1.5 or 1.35, and that'd be 1.36. That would be a change of one pip. Yeah. A price movement at the fifth decimal place. Price movement at the fifth decimal. Is a pipette. Price movement at the fifth decimal place is a pipette. Right, okay. What is a lot in forex trading? Currencies are traded in lots, which are batches of currency. Right, okay. So currencies are traded in lots, which are batches of currency used to standardize forex trades. As forex price movements are usually small, lots tend to be very large. As the forex, for example, standard lot is 100,000 units of the base currency. As forex price movements are usually small, lots tend to be very large. Right, okay. Lots tend to be very large. So, okay. How does forex trading work? Forex trading works only when you're buying one asset using currency. In case of forex market tells the trader how much one currency is. For example, the current market shows how many it would take to buy £1. Each currency has its own code. Different. Yep. Right, okay. What does it mean to buy or sell a currency pair? To buy a currency pair, it means what does it mean to buy or sell a currency pair? To buy a currency pair means that you expect the price to rise, indicating the base currency strengthening relative to quote currency. Price to rise, indicating strengthening relative to quote. So, to buy a currency, base currency is strengthening relative. So you would need to buy. So if you bought this, you are against USD at 1.35361. If you bought it, then you expect the USD. You would expect more USD for €1, right? You would expect more because you basically bought it at a lower price than if you're buying it at 1.36. Yeah, I think that made sense. To sell a currency pair means to expect the price which happens if the base currency weakened against quote. For example, you buy if you think the pound will strengthen against the dollar, meaning you need to buy more dollars to buy a single pound. Yes, or you sell this pair if you think the pound fewer dollars to buy a single pound. Right, okay. I think that's what I said earlier, maybe. What is a spread in forex trading? Spread in forex is the difference between the buy and sell prices. For example, the buy price might be that and the sell price might be that. If your percentage to be possible, you need the market price either rise above the buy price or fall below the sell price, depending on whether you've gone long or short. Ah, I see. So if you bought it at 1.3, so you bought it at 1.3428. To make a profit, you want this to go to 1.35, whatever. And if you want to make a profit on this, you want this to drop below 1.34, so 1.33 or something. Right, okay. So I should probably write that out actually. To make a profit, you raise above the buy price or lower below the sell price. Yes, yes. What are the margins and leverage and effects? Margins refers to the initial deposit you need to commit in order to open and maintain leverage position. Margin refers to margins refer to the initial deposit you need to commit in order to open and maintain leverage position. Open and maintain a leveraged position. So trade on EURG might only require in order for it to be open. As a result, instead of needing 100, you only need 3. Ah, right, okay. So I dot E dot was it EURGBP, Great British Pounds. Instead of needing you only need that much. You only need that much. Okay. Why do people trade Forex? Speculating on currencies, strengthening or weakening. Traders speculate for it to pray. Base is strengthening against the quote, and when it's falling, base is weakening against the quote. Right, this is important. I think this is a good summary. This is when the price of the pair is raising. This means the base currency is strengthening against the quote currency, i.e. more of the quote currency is needed to buy the same amount of base currency. When the price of the pair is falling, this means the base currency is weakening against the quote currency, i.e. less of the quote currency is needed to buy the same amount of base currency. That's because the rise in price means more of the quotes needed to buy a single unit. Yes. Scalping, day trading, swing trading, position trading. You might choose a difference by whether they have short or long term outlook. Scalping. Positions are open and close quickly with the aim of taking small profits. Close within a day. Traders look at higher low prices trading in the position. Open and live and watch. Ooh, this is a very good good image. I like. So I think this is some of the trading techniques to use, whether you want to go long term or short term. Hedging. What is hedging? Hedging is a way to mitigate your exposure to risk. It is achieved by opening positions that will stand to profit if some of your other positions decline in value, with the gains hopefully offsetting each. So basically, don't put your eggs in one basket. That's what hedging is. Hedging is a way to mitigate exposure to risk of losing money. I should write that. This is done by opening other trades that will stand to profit if some of your other positions are with the gains hopefully to offset at least a portion of the losses. Currency correlations are efficient ways to hedge forex exposure. Currency correlations, example BU and G, which are positive correlation because they had move in the same direction. Because it had, so if you could go short on GP, you could if you had. Example would be positively correlated because they tend to move in the same direction. So if this one goes down or decreases in value, or the price goes smaller, this would usually go smaller as well. Okay, seize opportunity 24 hours a day. The forex market is thanks to a global network. The main sessions are in 24 hours. AM PM Asia Pacific European. So this is where I am European, and this goes back to Asia Pacific. So 9 till 10. That might be the daylight saving time, maybe. So okay. The forex trading market, I'm practical for you, surprise weekend trading. Right, okay. Learn how currency markets work. Wait, how long? Right. 44 plus. Right, okay. I think I'm going to stop here. Thanks for watching. Goodbye. See you next video. Ciao, ciao.